right. Good morning. Good morning. It's fun to be here at the 36th Annual Marine Money Conference. Thank you to Matt, Michael, John, Lorraine, and the whole Marine Money crew for helping bring us all together. I'm Nolan Olsen, Managing Partner at Langschiff Capital Partners. Langschiff Capital Partners works with shipping sponsors and operators to raise institutional private capital from investors in North America, such as insurance companies, pension plans, endowments, foundations, and large family offices. Langschiff works with sponsors and operators generally over a 3 to 4 year period and leads the fund sponsors through the process of raising an investment fund and co-investments. As part of our role, we're always consistently educating institutional investors on shipping opportunities in private markets and always striving to bring new institutional investors into the shipping industry. Today, we have a distinguished panel of shipping fund sponsors who manage investment vehicles that invest both in private markets and opportunistically in publicly traded shipping companies. The shipping fund managers have invested across almost all sectors and geographies and in some point together, in some projects together. Over the next 30 minutes, we'll talk about investment strategy, fundraising, lessons learned, advice for those looking to launch shipping funds, and to reference yesterday's panel with Evangelios Marinakis, we will ask each of the sponsors for their areas of light. Starting to my left, we have Atef Abou Merhi, Managing Director at Pelagic Partners. Nicolas, pardon me, I'm going to butcher this, Tirogalas, President of Tufton Investment Management, and Andy Tuchman, Partner at Blue Ocean Funds. Gentlemen, if you could please introduce yourself and share with us your journey to becoming a shipping sponsor and your approach to investing.
I start first?
Please.
All right. Yeah, thanks, Nolan. So from our end, I'm a co-founder and co-managing director of Pelagic Partners, which has been founded around 5 years ago between Dr. Niels Hartmann and myself. So basically, what differentiates us a little bit from other fund or fund managers is that our philosophy is based on 40 years of ship owning, whether it's from the Hartmann side or from our side. And our focus on setting up a fund was very coincidental because we have been focusing on our shipping businesses as a family and as a group. And 5 years ago, we thought that it would be interesting to open up, since so far we have not worked with third-party investors. So our idea is how to tap various investors, whether it's public markets, project-based, and then we came along with the idea of setting up a fund, funded ourselves through equity. So initially, the whole fund was just sponsored by us as founders. And on top of that, we put our expertise as owners that has been doing this job for many, many years and invite investors to join us, which has taken place in a way. So in that sense, our journey has led up to today, where we have asset under management of around 400 million, mainly with main equity coming us as founders and family offices and high net worth individuals joining us as well.
Hi, so I'm Nicolas Tirogalas. I'm the president and CIO of Tufton. Tufton has been around for 39 years. We've been running institutional capital for various European and non-European investors. We have been doing this through 7 currently investment mandates, different strategies. We run 2 public companies. We run private capital. We have diversified fleets and opportunistic strategies in different sectors and strategies. And we've been doing it for 39 years. So probably the oldest guys around for that.
Hi, my name is Andy Tuchman. I actually did not start in the shipping industry. I was a high-frequency options trader, so complete opposite side of the spectrum. I met my current business partner, Jake Scott, who does have a long history in shipping, and we met about 10 years ago. And the one similarity between options trading and shipping is the importance of volatility. And so once I got to learn a little bit about the shipping industry, the high vol and the opportunities that it presents really attracted me to it. And so we started making investments about 10 years ago, partnering with some family offices. 5 years ago, we started taking real outside capital, and we have a sort of a unique approach that's different from most private equity firms. We don't raise just a fund and then go do a bunch of things. We raise 4 specific direct investments. And so we bought our first direct investment was a company called Womar Tankers, which is a chemical tanker pool commercial management company. We bought that in 2019. Subsequently in 21, 22, and 23, we raised 3 different asset funds to buy tankers, which were then, of course, managed by Womar. And we really like that distinction between operating company and asset companies. We found that it allows investors to have a really clean investment thesis. There's no reinvestment risk. There's no management risk. It's a discrete trade. And then ideally, you show good returns, and those investors want to reinvest with you in the next things. And so after we've had some success in tankers, we've now set up a dry bulk operating company. We have not bought any dry bulk ships yet, but we want to be ready if and when the time comes. And most recently, we bought into an offshore service vessel company called Golden Energy Offshore Services. And we plan to use that as sort of a launching pad to build a bigger footprint in the offshore service vessel space.
Now you make our business model look bad.
That's a good segue in. As you've all been in the game for a long time, and you've seen, how have you seen your business model evolve, and where do you think it'll be leading the next 5 to 10 years?
From my end? So since we have started specifically under the brand of Pelagic Partners back in 2020, it was basically you could buy anything and make a good return on it. It was right into COVID, even though there were a lot of uncertainties, but everything was quite underpriced. So the main difference between back in the days and today is that before our focus was more asset play driven and basically buy and hold on into assets, given where the nature are of the cycles and the sectors most of the vessels were trading in. On top of that, we were and still are focusing on investment to segments that we understand ourselves and have worked in through our groups around the Pelagic. What has evolved until today? Today we're being very cautious in what we have been doing. The vessels that we have bought at the down cycle, we are enjoying the ride with the appreciation of asset price and the free cash we are getting. But the days today have changed. Today the focus is more cash flow driven, counterparty driven, and in a way some certain niche which we will discuss also in a bit. Otherwise, to make sure that investment and running a fund is also not just about buying and selling, but we're also focusing on keeping our leverage low in this current cycle. So we have around a leverage of 30-35% on our overall asset. So keep the break even low as much as possible. Clean up the balance sheets, give a little bit back to investors, including ourselves as being investors as well. So this has been the focus today compared to the start of Pelagic.
So to answer the question with regards to where do we see our industry going, the reputation of shipping in the public markets hasn't been the best, let's say, over the course of the last 15 years. However, over the recent last few years, there have been a lot of examples of financial players who have made a lot of money in the shipping industry. And that, what we see on our end, is we see increased institutional investor appetite to expose themselves in the shipping sector. So that is very promising on what we do. And of course, once you have the track record over the years and the performance that goes with it, we are now dealing with inbound solicitation effectively for presenting investment opportunities to multiple institutional capital providers for shipping. And that is a very good sign for the shipping sector. Now, whether that will prove to be a good thing over the years, we don't know, because when institutional capital gets involved, things tend to go sour. But we hope that won't be the case this time around.
So I guess I'll just offer what I think is a U.S. perspective, which is, shipping is obviously global business. I'm sure most of the people in this room are even not from here. And the knowledge base of institutional investors outside the U.S. is so much higher than inside the U.S. And so when you're talking to investors in the U.S., there's a really big educational hurdle that you have to go through. And that can take a really long time, especially because many, if not most, institutional investors in the U.S. like to put shipping into a infrastructure box because it's a big, heavy thing. But obviously, the risk-reward profile, the returns, are anything but a standard, low-risk, low-return infrastructure investment. And so shipping doesn't really fit well into a specific asset management box. So you usually have to find a little bit more flexible pools of capital and really do a lot of education before, at least we've had to do that, before getting investors comfortable with investing.
Andy, agreed, and that's a great segue. As you think about the lessons learned on raising outside capital for shipping, and why don't you take this and we'll work back down the line. What have been the lessons learned and kind of your plans for expanding your capital base to support growth?
Yeah, so like I mentioned, education is the biggest hurdle. It's like building any other relationship. You start out small, you hope to do right by your partners, and then you hope to grow that. And so we've had repeat investors in all of our funds and all of our direct investments, and we hope to grow those, and both within the specific pools of capital from those allocators, but then also hopefully to access the larger pools of capital that have at least until pretty recently, I think, been scared of shipping. The institutional investor market works on a lag, and so usually they want to see a couple years of steadiness in any industry or any asset class or any risk profile before they get comfortable. And so it's been a couple of good years across almost every shipping market, and so I think we're getting there, and we're getting close to being able to sort of be a more mainstream investment vector.
I think our lessons learned are probably around track record and the number of years that you've been doing this and how you have performed through different times in the cycle, because that's important too, because investors, when they look at you, they ask you, okay, how long have you been doing this? And it's a very reconforting information when you know that someone has been doing it for a long time and performing quite well, both publicly and privately. As you know, we run two public companies, and we have investors that see what we do publicly and privately. You should ask Andy, because he's one of our biggest investors in one of the two public companies. So, but I think our lessons learned, track record, and length of doing it is very important when you raise capital.
From our end, I think the main thing learned over the years has been alignment of interest. I think alignment of interest has been a key point for us and will stay so. We haven't, as a group, we have been there for many years, but to tap on third-party investors in capital has been new meaning 4 or 5 years. And I think the secret sauce for us was that we put our money in first. We try to have a big part of the equity, no interrelated party transactions, full alignment of interest with the investors. And on the track record side, we show that even though the brand is a bit on the new side, but whatever we are investing in, the people behind it have been doing that for many years with their own money, and have been doing it in a steady and successful manner. So alignment of interest is very good, is very important, along with the track record, whether it's on the private side or within the investors. That will be the key point for whatever cycles we're going to come in the future.
Well, we have to ask the obligatory decarbonization problem, or decarbonization question. Decarbonization has not been a moneymaker. How are you looking to invest in decarbonization? Whoever wants to take it.
So I'll start. We're not. We're not. We don't have a mandate. We're not looking to sort of stamp our mark on the world. We're looking to make returns for our investors, and so that doesn't mean we're not interested in decarbonization. It just means we're agnostic. And so if the returns are there, we've looked at a lot of projects in the U.S. offshore wind sector, and frankly, it's just we don't understand how the numbers work, and so we've never done anything there. Hopefully there will come a time when that happens, and then we'll be interested, but we really just, the returns are the focus of our investments and not the story around the returns.
So we have a current significant mandate to deploy capital, what we call green energy transition, which is meant to be a yield, steady yield vehicle that has some kind of green element to it, whether that's the dual fuel technologies, propulsion technologies, etc. What we have seen is that, and Andy's probably right, a little bit on the, obviously you provide, different investors want different things. Other people want high vol, other people want low vol, lower returns, of course, that go with them. In today's environment, it has proven a significant challenge to find the investment opportunities that even meet lower return potential projects. So we are looking at long-term type of transactions, but the charters need to be there to fix ships at premiums for longer periods of times in order to make their returns work and residual value risk decrease. That's proving to be a challenge. Obviously, for diversified strategies, the way to play it is, you put a lot of ESDs on vessels, and we're doing a lot on our existing fleet, and obviously you try to go towards fleet renewal somehow and improve. We heard people yesterday talk about a lot of decarbonization happens on the existing fleet and technical innovation and advancement, and we're doing a lot of that. So that is one way, and we've seen that even on an individual CapEx, returns can be in the low teens, which is pretty attractive for doing good and making money at the same time.
Yeah, I agree that investment on current vessels is actually one of the best returns that you can get these days. I agree with Nicolas. So besides retrofits on vessels on the water, we are quite invested, which is specifically in the wind offshore side. So for us, we consider ourselves being invested into the green energy transition. And this is not because there is a stamp or a mandate. This is because we believe in that sector in specific. So looking at the green transition in that sense, there's actually two sides to it. One, the underlying market is the wind offshore market, so wind energy, which is probably just 0.5% of current energy mix in the world, and this will go tremendously up until 2030 onwards. And the vessels that we are building, they themselves are very green, if you want to call it that way, with being methanol ready in the battery pack and so on. So we are trying to build the vessels as green as possible to be able to accommodate the energy transition, at least on the wind side. However, as Nicolas just mentioned, when we went ahead and started with pelagic wind, specific the dedicated compartment for this segment, we went out to the market, and yes, we have seen the resistance from investors, mainly asking, okay, where's the cash flow, where's the securities, and so on and so forth. So here our ship owning DNA has kicked in, and we said that, okay, if the investors still feel that it's risky, we as ship owners believe it's not, or not risky, a low risk compared to the other segments. So we went ahead and did it ourselves as founders. It's purely our own equity, where we have went ahead with ordering the 2 firm vessels plus 4 options. And by the time we get them delivered next year and have currently having tenders, then I believe it will be much more interesting to invite investors and join us when there's more visibility on the cash flow.
Great. For all the people in the audience who may be thinking of starting shipping funds, what advice would you have for them? Andy, you want to go first?
Yeah, I'd say if you have an idea for a shipping fund, come talk to us. But seriously, I would say, what we did is we started really small, taking ships on time charter with industry partners. So really low risk, low dollar amount, and just slowly but surely built our track record, built our knowledge base, built our relationship networks, and yeah, it takes time. I mean, starting anything new takes time, and so I would say, make sure you give yourself enough time to see it through to its eventual success.
I fully agree. I mean, it's patience, so it takes patience, but most importantly, I think it's having the best team around. You can't. It's something that you can't do on your own. You really need to have the best teammates in order to be, that complement each other. We also have both owner and financier experience in our team, which I think it's a really good thing to have as well, because you understand a little bit how the owners think when you look at investments, when you do partnerships with industry players. But Andy's right. I mean, you can't do it overnight. I mean, you have to start with one deal, probably start small, have the patience, right people, entourage, the right team, and then you at some point, if you're doing the right thing and you're doing what you've told investors you will do, then you'll see that repeat money coming in and supporting new strategies and new initiatives.
Yeah, I don't think I have much to add on that. It's a competitive space to be in. You need to have a very good story to start, the right support, probably anchor investor, whether it's a ship owner or institutional capital, but this will not come overnight. So I totally agree with the gentleman.
All right, and last formal question. Kind of the usual MSI type of favorite area / areas of light. Nicolas, you want to go first?
Areas of light. So you mean where do we invest today? What do we do? I mean, we like certain sectors more than others today. We like a lot the chemical space, of course, where we've put a lot of money to work. We always believe in the diversified strategy, but probably looking, tankers still attractive. Offshore, of course, people are looking at it. Different views there. I would go into, we're launching a venture capital arm, which is something that we haven't done until now, but we've brought in the right people to do so. So I think that is an important thing in order to help decarbonization, digitalization of shipping. It's one element where we want to be present, and maybe what would be different would be to look at asset light type of setups and strategies. So other things within shipping that are not purely asset-backed investments. So.
Yeah. I mean, from our side, it's definitely a special place to be in now, because we need to think outside of the box. And in terms of segments, we definitely still believe a lot on the OSV space / PSV, along with the Blue Ocean. Andy and Jake, we are co-owners in Golden Energy Offshore. So we still believe the supply side of that story is still very, very attractive. And one of the first orders that we have read over the news the past few days, I think is justifiable as well, given where the supply crunch is coming in. Hopefully it will not become a trend. I don't think it will become a trend, given the prices, yard availability, and the overall structure of the market. But yes, we do believe in that sense in terms of segments. Otherwise, what we are focusing on is to invest into assets that are more cash flow driven and counterparty driven, rather than purely asset exposure. We will soon be also launching pure liquid type of investments, because we believe if you are invested into certain assets, you might be locked up in there, but there could be a lot of value on the liquid side in that, especially since we have made our first sort of small public investments, that this would be an interesting space. On the offshore wind, we believe we need definitely some consolidation. There's too many 1-2 vessel owners along ourselves. So I think we have 15, 16 different owners. It's a very, very strong owners market. So we need to make use of that. If there's consolidations in place, we will definitely be in the driver's seat. And a bit short, medium term, we really like what's happening in the car carrier space. I think what's building up in the car carrier space will be an attractive entry point soon, where the order book is. Ports are filled up with factory new vehicles that are not finding the right, their way into the market. A lot of EVs have been exported from China, probably due to political reasons as well. So this will stop. Red Sea effect, we will see when this will end. So with that in mind, we believe the car carrier space is really opening up for a very, very, very attractive change, probably in 2025, 2026.
Yeah, so as I mentioned before, we're really focused on the offshore service vessel space right now. That's where we envision deploying, I think, a large chunk of capital in the next 6 to 12 months. But shipping is also, you have to be really opportunistic and open-minded. And I think a lot of people like to look at each shipping sector or vertical as a sort of a commodity. And while each sector does exhibit aspects of commodity markets, there are also lots of unique opportunities that happen within sectors. And you could have a sector that you hate, but a deal come around that you love. And so I think it's just important to turn over as many stones as you can, meet as many people as you can, look at as many opportunities as you can, and be prepared to reject the vast majority of them in order to find the right one.
All right. Well, I think that'll conclude this panel. So thank you all. Thank you, Mike, Matt. Appreciate it.